Good morning, ladies and gentlemen. Welcome to Shareholders. We've earlier this morning released quite a detailed cautionary on a fairly significant transaction in the history of PSG. I'm now going to take us through the slides to give more context to how we ended up in this position. So I'll talk about PSG Group, investment holding companies in general. Then we'll go on to the proposed transaction, and then afterwards we have a chance for questions. On the email, on the SENS that went out, there is an email address if you want to put some of your questions to us already. But after the presentation, we'll have about a minute's pause, and then we'll start dealing with the questions. So PSG Group, we were founded in November 95 by Piet Mouton and Chris Otto. The share was trading at just 36 cents at the outset. PSG's dream originally was to build a financial services conglomerate, and through innovative transactions, we largely achieved that goal by the early 2000s. When the A2 banking crisis hit, we restructured the group to resemble what it is today, i.e. an investment holding company. We've always had it as our mantra to do what is best for shareholders. And over the past 26 years, we've been part of creating great businesses, including Kiro, Consult, Capitec, and many others, providing them with strategic input and capital. A significant part of our DNA has always been to appoint excellent management and empowering them to do the right thing to build the business. Yannick coined the phrase ultimate empowerment. And we listed the business because we believed the companies would perform better in front of the spotlight than at the back of the stage. We called this the Usain Bolt effect. Through the years, we have listed more than 15 companies in which we held a significant stake. However, in time, business regulations and investor sentiment or preference change, and management teams should be able to adapt. I've been quite vocal in the past about the ever-increasing red tape in the listed space and the benefits that especially investment holding companies get are negated by the ever-increasing regulations. Our investment model has fallen out of favor not only in South Africa but globally. And the discounts that you see in listed companies negates one of the biggest benefits of being listed, i.e. to raise capital from the market. So we cannot use script to buy businesses, neither can we raise equity funding to buy businesses for cash. We've seen it over the last couple of years where investors prefer investing into private equity funds or investing directly in the companies of their choice. This might change in years to come, but for now in the foreseeable future, it is the reality. Initially, when we invested, the companies benefit from what we call the big brother effect. But once they become more mature, operate efficiently, and are well capitalized, they are penalized from a JSE index perspective as their trading liquidity is impaired because of their small free float, and maybe they aren't included in indices. PSG Group's total return since 2010, when the current management took over, has been 28%, and since inception, it's been 38%. I might add, it's not been the easiest trading conditions since 2010, as we've had extremely low growth in South Africa with the last couple of years with the effects of COVID hitting us. Our primary goal, and we've been unashamedly about this, is to maximize shareholder value. But we've been trading at a 30% discount for several years now. And 2 years ago, we unbundled our stake in Capitec, creating about 21 billion for shareholders, but still PSG trades at a 30%, approximate 30% discount to its sum of the parts. On this slide, it's fairly busy. I'm not going to go into detail too much about it, but you can see in February 2020, when we still held the Capitec stake, we were trading at a 32.5% discount. Currently, post the unbundling, we are still trading at approximately 32% discount, even though the portfolio has grown quite nicely the last year from 94 Rand to 122 Rand per share. Just generally on investment holding companies. This slide details the major investment holding companies listed on the JSE. You can see that the trend has been downwards over the last 5 years, with the average discount of these companies sitting at approximately 41%, with ourselves trading just over 30%. After years of investor meetings, I've gathered the following as to why investment holding companies are trading at a discount. Number one, investors don't like the fact that investment holding companies have permanent capital. There is an inherent tax trap in investment holding companies. Some of the investment holding companies have made poor investment decisions, and I think this spills out to the sentiment of other investment holding companies. The same goes for excessive fee structures, where some of the investment holding companies charge excessive to manage their portfolios, and this spills over into the general sentiment. And then too many listed entry points. I believe I'll give PSG a score on this. You might differ with it, but this is our opinion as management. On permanent capital, I give us a green. Over the years, we've returned 6.2 billion in dividends, 0.7 billion in special dividends, and as I've already alluded to, Capitec was recently unbundled, creating 21 billion for shareholders. The tax trap, unfortunately, is a red. Inherently, at the moment, if we had to sell all the assets at market value or the current value, there would be 3.3 billion CGT payable, which is a 13% reduction in the sum of the parts. If this is then distributed in the form of a dividend to shareholders, there's an additional 20% deduction to the ultimate shareholder. Poor investment decisions. Again, I don't think we can be faulted for this. I've already alluded to the returns we've given shareholders, both since the current management have taken over and since inception. Excessive fee structures. Again, the market cannot say we've charged excessively. Currently, and the latest figure is that the operating costs of PSG Group relative to the sum of the parts and the market cap is approximately 0.1%. That is significantly lower than what people charge in private equity funds or in unit trusts. Too many listed points. Historically, it's unfortunately been part of our DNA, and 91% of our portfolio is in listed investments. So unfortunately, I score us a red there. There is, however, investment holding company discount dilemma. Once you start trading at a discount, and I've alluded to this already, when I said the key rationale to be listed is access to capital markets. Investment holding companies do not get advertisement benefit from being listed. It means that if we go into the market and we raise equity of 100 Rand, the next day it's worth 70. Or we can raise equity via a rights issue, which will be a severe dilution for shareholders not following their rights. So effectively, the equity capital markets are closed to us. The result is that going forward, you have to manage your portfolio more conservatively. We've estimated that to be able to play a key role going forward, we would need to retain a cash buffer of between 15 and 20% of the portfolio, which is either cash or funding lines, to be able to support the underlying portfolio. As we all know, the returns on cash are lower yielding and should reduce the returns of PSG going forward. You become tentative to make new investments, because once the cash is investments, you cannot get access to new cash. So inactivity makes the business unexciting. The same goes for dividends. Investment holding companies become loath to pay dividends because once you've paid the cash to shareholders, you cannot get it back again. This reinforces the shareholders' irritation with the fact that investment holding companies sit with permanent capital. And if you take all this combined, it reinforces the discount, making a vicious circle of trading at a discount. I've talked about the tax trap. Rightly or wrongly, investment holding companies have significant challenge and the market is discounting them severely. If you just go for a scenario where PSG sells all its shares and distribute the cash proceeds to shareholders, we will see the following. The current sum of the parts as published is 25.5 billion. If we had to sell everything, there would be 3.3 billion of CGT, and then on distribution of the dividends, another 4.4 billion would be paid. If you focus on a per share basis, the 122 goes down all the way to 85 Rand per share. And this is approximately the price at which PSG Group trades. So there is a significant argument to be made that investment holding companies trade at such large discounts as a result of the tax trap. Okay, so we do not believe running a conservative portfolio is very interesting for management, nor do we think it's in the best interest of shareholders. At every single meeting I have had with the investor community over the last 5 years, a significant portion of the discussion dealt with value unlocking strategies and what are we planning to do. Those of you who've logged into our AGM and investor presentations will know a lot of the questions deal with this. We have considered all options, from large share buybacks to buying out the minorities of the underlying investments. Simply put, share buybacks only have a relatively small impact on the sum of the parts. For every billion we invest, we only increase the sum of the parts by approximately 3%. And then the cash is gone and the discount is likely to open up again. And it's simply too expensive for us to take the underlying investments private, as that would need to be done at a premium. So here with the proposed transaction. PSG is proposing the following transaction. We will unbundle our stakes in Consult, Kiro, CANS, Kaapagri, and 25.1% in Stadio to our shareholders. Thereafter, PSG will repurchase the shares of all shareholders except management and the founders. For the moment, we call them the remaining shareholders, for 23 Rand per share in cash. We will then delist PSG from the JSE. Shareholders, except the remaining shareholders, will vote on the transaction. However, it is important to note that steps 1 and 2 are linked. meaning shareholders need to approve both the unbundlings and the cash repurchase offer for the transaction to be implemented. To be clear, should the unbundlings be approved but not the repurchase, then the proposed transaction will fail in that case. There are a number of steps to enable PSG Group to unbundle certain assets. Yesterday afternoon, Zeder announced that they will unbundle their investment in Kaap Agri. PSG Group will, as a result, obtain 20.5% interest in Kaap Agri. DePayo, our BE company, has informed us that they are intending to selling or distributing some of their assets to settle their pref share funding. PSG Group is considering same, which might lead to PSG Group increasing its stake in Kaap Agri to 34.9%, which we will then unbundle to shareholders. CNANS, towards the end of last year, they are listed, just for the record, on the Botswana Stock Exchange and the Cape Town Stock Exchange, have informed us about their intention to list on the JSE. And I think that is fairly important given the unbundling that shareholders would be able to easily trade in their shares. What does it mean for PSG shareholders? We've closed it off on Friday, the 25th of February, the calculation. At that stage, PSG was trading at 82.31 Rand. If you look at the value of the unbundled shares on a per share basis, it's about 91 Rand per share. If you add the repurchase offer of 23, you get to a total offer to shareholders of 114 Rand per share, which represents a premium to the share price of 38.4%. But given that the share prices of our underlying companies and PSG Group do not always move 100% in sync, we've included the 30-day VWAP, 60-day and 90-day VWAPs and have a look at what the different premiums is. And one can see on a 30-day VWAP, it's approximately 36%, 60-day 32%, and on 90-day 34% premium. We feel we've always been transparent and focused on what is best for shareholders. One could argue that the best for myself and my management team is to sit back and maintain the status quo, being remunerated while waiting for market sentiment to change. We do not believe this is the nature of PSG Group, and the executives share that sentiment. Then I want to get to the next bullet. It's not been an easy decision to make, nor for the board, nor for the founding shareholders, as this is the end of an era which many people dedicated their lives to build PSG Group what it is today. I've mentioned it, I've grown up with PSG Group in the house. My sister once said, when we were having discussions at a Sunday braai, Dad, that's not Jannie, you know, you do have 3 other kids. The only thing you want to talk about is PSG. It's like it's by far your favorite kid. So for us, this is the end, and it wasn't taken lightly. However, we firmly believe that the value that we have created or that we can unlock in terms of the transaction is the right thing to do. Now, on the companies we intend to unbundle, they all share the following attributes. They have exceptional management team and experienced boards. They are well-established businesses, and each one of them is well capitalized. And for their organic growth plans and for the foreseeable future, they don't require additional capital from us. This also holds true for Stadio, but I'll get to them a little while later. The remaining shareholders have given the undertaking that they will now simply hold their shares directly in these companies, and they intend to hold them. We are excited about the growth prospects, and we believe in these businesses. the market must understand that they have been fundamental to what PSG is, and we have no intention of selling. Furthermore, we've spoken to the companies we've unbundled, and the PSG Group and PSG Alpha executive directors will continue to serve in their respective existing capacity as non-executive directors of Consult, Kiro, CAS and Stadio. And Johan Leroux, the Zeder CEO, will continue to serve on the board of Kaap Agri post-unbundling. Following the share repurchase, PSG Group will be delisted. The unlisted PSG Group will retain the following investments. All the unlisted investments are remaining share in Stadio and 48.6% in Zeder. Why are we retaining the unlisted investments in PSG? Many of these companies are still in the early stage of their life cycle. It must be said that some of them over the years have disappointed and missed targets. This has not always been in control of management. For startups, a low growth environment makes it significantly more difficult, as people are less likely to go out of their normal way of doing business. Most of these businesses continue to require our strategic involvement, and we must be ready to provide capital for growth if needed. From experience, we also know that in terms of early stage investments, some of the companies will make it, some of them will be okay, and others will simply fail. When PSG Group invested in these unlisted companies, we committed to assist them and guide them through strategic objectives, to achieve their strategic objectives and to provide them with capital. We are not about to renege on this moral obligation. On Stadio, why are we retaining some of the stake? It's based purely on a commercial basis and where Stadio finds itself in its development phase. We believe Stadio has made great strides over the last 5 years, and please remember this is still a very young company on delivering on their strategy. We are extremely proud of what the management team has achieved in this relatively short period. But please remember, Stadio has undergone significant change as it went from a collection of standalone tertiary education brands to combining most of their operations under a single Stadio banner. Furthermore, the opening of the Centurion Mega Campus this year is a significant step change for them. The management team of PSG Alpha has from the outset been intricately involved in the formation and implementation of strategies at Stadio, as well as the identification of bolt-on acquisition. So given where Stadio is in its development phase, we firmly believe they will continue to benefit from the big brother effect of PSG Alpha's ongoing involvement. And that essentially is our rationale on that one. On retaining our stake in Zeder, following the unbundling of Kaap Agri that was announced yesterday, and the sale of TLG, which shareholders vote on the 15th of March, Zeder will essentially have 3 remaining investments worth approximately 3.6 billion. Considering the issues that investment holding companies have, and we firmly believe that a new smaller Zeder post Kaap Agri unbundling would not benefit from standing on its own. If we were to unbundle them, there would be significant downward pressure on this company, as it's different from the other businesses that we intend to unbundle. And we do not believe that's in the best interest of neither PSG nor the Zeder shareholders. Furthermore, when we internalized the management fee in 2016, PSG committed to the Zeder shareholders that we will continue to assist Zeder with its objective of maximizing shareholder value. we intend to honor this commitment. On increased trading liquidity, we firmly believe the companies that we unbundle will benefit from it. One can see that over a 1-year period, Consult only has a 7% liquidity, Kiro 13.3%, Carpagri 4%, CANS, okay, it needs to be taken account that the liquidity on the Cape Town Exchange and the Botswana Exchange is extremely low at 0.7% and Stadio at 10.9%. So we're likely to see better trading in these companies, and given where they are, the likelihood of being included in indices should increase significantly. We do have a set of conditions precedent, and I will remind everybody that this is still a cautionary announcement, and I'll get to the timetable just now. But some of the conditions precedent for the transaction is that we need to obtain shareholder and regulatory approval. And the next point is fairly complex, but it has to do with unbundlings. To the extent that a disqualified shareholder holding more than 5% in PSG Group on an individual basis doesn't increase to a level unacceptable to PSG Group board. Now what this means is, on unbundling, we as a company have to pay the tax on these unbundlings on behalf of these disqualified persons. The only disqualified shareholder we currently have is the 12.9% that is owned by the GEPF, the Government Employee Pension Fund. So unfortunately, we will be paying the tax on these unbundlings on behalf of the Government Employee Pension Fund. It's important to note as we lead up to the voting that if any other shareholder that is disqualified, and these are generally pension funds and foreign shareholders, increase their stake by 5%, we hold the right to withdraw the transaction. This is especially important because we've seen it in the past as we get closer to the voting date. Foreign hedge funds come in and buy up the shares, and they are very likely to be treated as disqualified shareholders. There are a number of internal steps that we need to take to complete the transaction. So the anticipated timeline is, we've released the detailed cautionary today. Towards the end of April, with the release of our financial results, the board will have a final deliberation on the transaction. Shortly after that, we will give an updated announcement and withdraw the cautionary. The circular should be posted in May. Voting will happen in July, and the implementation of the transaction will happen in August. Thank you very much. We're going to have a holding slide now and wait for the questions come in. In about a minute's time, we will address them. Thank you very much.
Thank you very much, Piet. This is indeed a historic moment. Please note that we are still under cautionary, and this presentation was mainly to provide context to the announcement this morning, and specifically the rationale of the proposal. Please also note the suspensive conditions to the transactions, as they contain specific exclusions. So I please want you to read the conditions carefully that's contained in the announcement. Now, there's been several questions posed, Piet. I think many of them has been answered now that you gave the presentation, because they were emailed before. For example, why the Stadio unbundling, etc. There was also a question, why not unbundle Zeder? I think you've answered that as well. And then also a question of why don't you increase the cash amount of 23 Rand per share? I think to a large extent you've also answered that.
Yes, I think, Johan, just to add on to that, I think the premium that we are paying shareholders is quite material at this stage, and the 23 Rand is part of that.
Okay, if we then go to, and part of this you have answered, Piet, so I'm just going to read the full question so that one sees the context, and that what is the estimate now of the CGT liability as a result of the unbundling, i.e. this disqualified investor unbundling above 5%, I think you've alluded to the PIC there on 12.9. Would the CGT impact the 23 Rand per share repurchase offer?
We've included the CGT provision within the latest sum of the parts that we've put down over there. Obviously, it needs to be clarified with the tax advisors, etc. Our best estimate has been put in for this stage. It won't affect for the moment the 23 Rand. I think the 23 Rand from our side is fixed, with the tax risk sitting on the remaining shareholder side of the coin. But why we've stated that it shouldn't increase materially, as I alluded, just as an example, if all the shares are owned by disqualified shareholders, then on the unbundling, the CGT would be approximately 3 billion. So we don't want it to increase materially above the 12.9% or anywhere above the 12.9% that the government employee pension fund owns.
Thank you, Piet, and I think that's also the reason why the suspensive condition has been inserted in the announcement. Then the next question is, why not give investors an option to remain in a smaller listed entity?
Maybe I can answer that the reality is that it doesn't solve our problem at the end of the day, that the listing environment for investment holding companies is not favorable at this stage. I don't think it's going to change. We've done all of this to solve the discount level. If we retain the listing of PSG Group going forward, we believe that the discount, given the size of the company purely, will open up even more to levels of 40+%. It will just fall outside the interest levels for most institutional shareholders.
Okay, thank you, Piet. Yes, it starts by, thank you, Piet, this is a bold move by management and will create enormous value for shareholders. May I ask, when will we see the final announcement? Now, I think Piet alluded to that. We hope it's around the end of April, but we will keep shareholders updated as we progress. Just 2 seconds, I'm just see there's 1 or 2 questions coming in again. This is an end of an era. It will be immensely sad to see PSG leave the bourse. Well done on a hard decision to unlock value though. With the remaining unlisted investments in the unlisted PSG, will your preferred route remain to list these investments at some stage, or has this also changed?
I think each company within the group on that of the unlisted companies and their board should make a decision what is best for their companies. Now, for some of them, it might be a listing. For other companies, they might want to stay private indefinitely. There are definitely, for operating companies, still significant advantages to be listed in terms of tradability, where management obtain large stakes in the companies, but also there is a sense of free marketing that operational companies get. And also, if they are in the right space, the rating that they can get from the market might be significantly more that they can obtain in the private market.
Thank you, Piet. There's another question around the CGT, but I believe you've answered that. Also, what is the future plan for Zeder? Now, I must say this is just a cautionary and we can't speak on behalf of another listed company, Piet, but I don't know if you want to add.
I agree with you on that, Johan. They are trading under cautionary, even post the unbundling notice and the sale of TLG. I think even if they do speak to Zeder, it would be, they won't get the answers they want. I think we should wait till they release their results in April, and hopefully there's a better update at that stage.
Thank you, Piet. I'm going to give it another 20 seconds. I see no further questions here. Thank you very much.
Thank you.